Hello everyone, my name is Zach and welcome to On Cash Flow, where I help you become a master of your own cash flow. Now let's get started. You might have the wrong investment product in your portfolio. It might not really be that big of a deal, but I know that you as an optimizer, you want to optimize everything, right? Because that's what I want to do. And if you're watching this, you're probably a little bit like me. But if you want to optimize your portfolio, then you might be making a small mistake by having a mutual fund instead of an ETF in a taxable investment account. We're going to be discussing mutual funds versus ETFs, and more specifically, why I personally switched all of my investments from mutual funds to ETFs a few years ago. And I'm still going strong on that. And perhaps it might be something that you want to do. Now, this sounds like it's going to be something drastic, but it's not really that big of a deal. All right, and we're going to unpack all of this right now. So the secret is out. I think that ETFs are pretty much superior to mutual funds, but that wasn't always the case. Okay, I didn't always believe that, but now I kind of do. I kind of think that ETFs are pretty much superior to mutual funds in almost any regard. Real quick, let's just discuss what the differences are real quick. So I'm going to be referring to index funds, and when I mean index funds, it can mean both mutual fund and both ETF. All right, so specifically if it's a ETF, when we're talking about an index fund ETF, we're simply just talking about a fund that trades on an exchange that tracks an index. It's right there in the name, so it's really easy and simple to understand. When we're talking about an index fund mutual fund, we're simply just talking about a mutual fund, an investment that pulls multiple investors' funds together to invest in something that tracks an index, right? Very simple. It's kind of also in the names. If you have a basic understanding of those, then you have a basic understanding of what an index fund is. It can be either or. Ultimately, at the end of the day, it doesn't really matter which one you invest in, the mutual fund or the index ETF. If they're both index funds, it doesn't matter that much. What does matter is that you hit the like button on this video, okay? Because we have so much to talk about. So let's just get this out of the way right now. Hit the like button if you're enjoying this so far. I know it's only been a few seconds, but hit that like button. I would really appreciate that. We have so much more to cover and it's going to be pretty fun. The reason why I say it doesn't matter that much is because both of them have some really great advantages, okay? Both index ETFs and index mutual funds have some amazing advantages, and they just cannot be understated. First off, both of them are able to offer you instant investment diversification. So this is pretty darn cool because you can take, let's say, $1 and you can divvy that up into literally thousands of different companies, you know, with 0.1% invested in this company and 3% invested in this company. Like if we're talking about like a huge company like Apple, if we're talking about investing in an index fund, then that giant company is going to represent, like, let's say, like 3 or 5% of your portfolio. So if you take $1 and that is 100 cents and 5% of it, so 5 cents is going towards Apple, you know, that's how it kind of divvies it up based on how big those companies are. So it's amazing because with both of these, you can achieve instant investment diversification. Another thing that both of them can do, which I already kind of alluded to there, is that you can invest practically any amount of money. You can sometimes start with as little as $1, you know, $5, $25, you know, just small dollar amounts, and you can instantly invest those. You don't have to start with thousands of dollars. So it used to be back in the day, you used to have $3,000 to get started with this mutual fund, or you used to have $5,000 to get into this mutual fund, or $10,000 to get into it, or even with ETFs, once they came on, you had to have the exact amount in order to buy one ETF. Well, that is no longer the case because now we have $0 investment minimums. We can buy fractional shares, which basically means we can buy less than one share. You know, we can buy half a share, or you can take any dollar amount nowadays and you can invest it. And when you invest any dollar amount with both of these, the great advantage, ETF and mutual fund, is you can get extremely low expense ratios. And that is one of the pillars of having a pretty good investment portfolio that most of us need to have. Most of us should be going after low expenses when we're going after index funds. That applies to both ETFs and mutual funds. Another amazing thing about both of them is that we have no trading fees anymore. Thanks to market competition among all of the online discount brokers and stuff like that, we don't have to pay $5 every time we buy and sell something. So it used to be that with ETFs, it used to be a disadvantage where mutual funds, they allowed you to invest in. Once you got a minimum amount, you can just, you know, make as many trades as you need so that you can keep putting money into the mutual fund. And you used to have to pay, like, let's say $5 to $10 every time you bought and sold an ETF, but no longer is that the case. So now there are no trading fees for either of them. So that's an amazing advantage of both ETFs and mutual funds. And speaking of no trading trading fees, that means that you can do all of this and let it happen in the background without you physically having to go in there and press buy and sell. So that means that you can automate your investments with both mutual funds and ETFs. It used to be back in the day that you couldn't do that with ETFs, but that was kind of like the big draw of mutual funds. Oh, you can have automatic transfers into the mutual fund and automatic shares to be bought. But now you can do that as well with ETFs. So there's like no competition there. So both of them are really great for automatic investment. And lastly, a great advantage of both of them is that since they are both index funds, they are tracking an index, which means their investments are going to pretty much very, very closely mirror that index, which means it's going to be the same returns, same before tax returns, I should say, for both of them, whether you're invested in the mutual fund or whether you're invested in the ETF. So they're going to be tracking the same index. They're practically most likely going to have the exact same companies, whatever that index is tracking. And so you're going to get these same before tax returns for both of them. Those are lots of great advantages of both index funds and ETFs, but there are some things that are going to differentiate them. Some things that are going to make some pros for the ETFs and some cons for the ETFs. Some pros for the mutual funds and some cons for the ETFs. And that's what we're going to discuss next. Since I am currently on the side more tilted towards the ETFs, let's start with the mutual fund cons. So I think that one con of the mutual funds is that it doesn't have multiple trading. Like you can't trade throughout the day with mutual funds. So mutual funds, their price is only going to be set once per day, typically at the end of the closing day for the trading day. And that is going to be based on their NAV, so their net asset value. So whatever that value is at the end of the trading day, that's what the mutual fund is going to trade at. So you can only execute your trades at the end of a trading day with a mutual fund. And I would consider that a con because it gives you less flexibility. And anytime you have less flexibility, I think that is a con because I love to be flexible. Now, I don't do any stretching, but I love to be flexible in other areas of my life. Secondly, another con when it comes to mutual funds is that they can be very tax inefficient if you're invested in a regular taxable account, like a regular brokerage account, not a retirement account, not a government sponsored special account. If we're not talking about 401ks or IRAs or HSAs or anything like that. So a regular taxable account, a mutual fund does have some tax inefficiencies. When the fund buys and sells things, it's going to trigger sometimes capital gains, and sometimes it's not going to be related to anything that you do. So you could have a mutual fund and you don't do anything, you don't buy or sell anything, but you could still realize capital gains from that fund because anything that the fund does, it's going to pass it on to you, to all of the shareholders in equal value. And so there can be some tax inefficiencies there. Typically, this is not that big of a deal for most investors, even if it is in a taxable investment account, but there have been some recent examples, more specifically an example with Vanguard, that have caused some pretty crazy taxable gains because of some crazy stuff that's going on there. So I'm not going to explain all that here, but I do want to link a video in the description below to another YouTuber, Rob Berger, and he is, a pretty smart guy when it comes to investing and everything. So he covers this topic of what happened with Vanguard. So I'm going to put the links in the description below for that video. But typically, yes, there are some tax inefficiencies with mutual funds. Sometimes some really bad tax inefficiencies with mutual funds. And so that's definitely a con that I have to mention when it comes to investing in mutual funds, especially in taxable investment accounts. Thirdly, another con when it comes to mutual funds is that typically you're going to be locked into where you purchased that mutual fund. Again, that's has to do with inflexibility. Now, it doesn't mean if you have a Fidelity mutual fund over at Fidelity that you're stuck with Fidelity forever. No, that's not how it actually works. But what I mean by that is you can't just transfer Fidelity mutual funds over to, let's say, Vanguard. So it's going to be very difficult because you're going to have to do some kind of conversions there. And there could be tax consequences depending on how you do it, especially if we're talking about a taxable account. Now, if we're talking about an IRA where it's already sheltered from taxes anyway, it doesn't matter. You can just sell it all, realize the cash, transfer it over to Vanguard and buy their funds. So you can just change mutual funds that way. But that still is some extra steps that can make it pretty annoying. And so that does limit your flexibility. And as you know, I don't like things that limit my flexibility, especially when it comes to my money, my investments. And I think that you should probably feel the same way. The reverse of those mutual fund cons, I think, can become ETF pros. So when I mentioned the first one, trading at the NAV value at the end of the day, ETFs do not do that. ETFs trade throughout the day. They can trade throughout the day. Their prices are going to fluctuate throughout the day. So this can be a pro because it offers you some flexibility. And then in addition to that, ETFs have much more tax efficiency. So they don't have that tax efficiency where if a fund buys and sells stuff, it's going to pass on those taxes to the ETF investor. So like it would with the mutual fund investor. So ETFs in a taxable account are going to be a lot more tax efficient. Okay, you're only going to be taxed when you make the buy, when you make the sell. You're still going to get dividends just like with a mutual fund, but you're not going to have that capital gains inefficiency when it comes to the mutual funds if you have them in a taxable account. And then when it comes to transferring funds between brokers, it's so much easier to do with ETFs. And that's why I personally invest now in ETFs, because I want that flexibility. I want to be able to move brokers. If my current investment broker is not doing as good as they could be, or if I know I have better options out there, then I might want to move. And ETFs make it very easy because they trade on the exchange. And as long as that broker has access to the exchange, which they all do, or else they're not a broker, then you can transfer it over. So I can take, for example, I have Vanguard ETFs. I can take those and I can invest them in Vanguard's platform. I can invest them on Fidelity's platform. I can invest it on Schwab's platform, all the different platforms. So currently I do use M1 Finance, but that is the point. I can transfer my investments, and I have done so. And it's so much easier if you are investing in ETFs rather than in mutual funds. But I do have to keep things fair here. Okay, so while I am on Team ETF right now, it doesn't mean that ETFs don't come with their cons. The same thing that makes them a pro can make them a con, and that is that they fluctuate in price throughout the day and they can be traded at any time. The reason this can be a con is that it can be very psychologically taxing to see your investments fluctuate so much, and you're going to see them fluctuate a lot more, if you're paying attention, if you have ETFs, than if you were to have mutual funds that only pretty much fluctuate at the end of the day. That psychological taxation on your mind of your investments going up and down throughout the day, that can be very psychologically taxing, especially if you are a newer investor or if you're not as in tune with how the market works and how that is very, very normal and should be expected. And another con of that actually happening is number 2, and the con of the ETF is that it can actually lead you to try to do market timing. So you can see that all of those fluctuations going, and you might be led to do some market timing. That's because the ETF, it can trade somewhat drastically throughout the day, throughout the week, throughout the month, and that could lead you to try to time the market. Like if you're trying to make your investment, you could be holding off, like you could be holding cash and waiting for the dip so you can buy the dip on the ETF. And I think that in general, for most investors, most of us individual investors, we should not be trying to time the market at all, because in most circumstances, it is a loser's game to try to time the market. But that's also my point with it being a con when it comes to an ETF. It could lead you to try market timing, and in general, I don't think that market timing is a good idea. Okay, that leads me to our practical recommendations here. In most circumstances, if you're talking about a retirement account, like an IRA, 401k, or even like an HSA, if you're talking about those kinds of tax advantage accounts, then it's not really going to matter too much, because you're not going to have that tax inefficiency of the mutual funds because it's already sheltered within that account. So when it comes to those kind of accounts, it doesn't really matter. If you want more flexibility when you can move your assets, then perhaps choose the ETF. If it doesn't really matter to you and you're going to be investing for the long run anyway, then you can choose mutual funds or ETFs, just whatever you prefer or whatever the best option is for you within that account. Practically, when it comes to a taxable investment account, a regular brokerage account, I'm going to have to say that ETFs are going to be the better choice here because of those tax efficiencies of ETFs when compared to mutual funds. Now, of course, if you do choose mutual funds, there's no problem with that at all. They are great investments if you're investing in index mutual funds, just like they are with index ETFs. However, if you're an optimizer like I am, then choose ETFs in your taxable investment account. Really quick, I want to know from you in the comments below, do you invest primarily in mutual funds, or do you have primarily your investments in ETFs? Which one does your portfolio favor? Me, right now, I'm pretty much 100% ETFs. I have a little bit more left in some mutual funds that I'm going to be converting pretty much into ETFs, but I'm trying to do that in a smart taxable way, so I'm kind of doing that over time. But pretty much I'm all in on ETFs right now. Now, I saved the best for last, and that is my own investment portfolio. I know you clicked on this video because you want to know more about me. No, I'm just kidding. But seriously, let me go ahead and put my actual personal example, because I think this can help a lot of people see how I'm actually investing myself. Right now, my current investments are very, very simple. I have 2 funds that I'm going for, and that is a Vanguard Total US Stock Market Index ETF and a Vanguard Total International Stock Market Index ETF. So I'm a 100% equities right now, 100% stocks, and they are all in Vanguard exchange traded funds. And the platform that I currently use right now is M1 Finance. So I originally started with Fidelity investments, and I have them in mutual funds, but I wanted to optimize my portfolio and I wanted to automate a lot more. And so I switched over to the M1 Finance platform. And now that is what I definitely recommend to everyone because I enjoy it so much. I literally have hundreds of thousands of dollars over on that platform and I couldn't be happier. If you're currently not using M1 Finance, then seriously, I would highly suggest you go ahead and just check it out. So I'm going to go ahead and put a link in the description below for you and in the comment below, okay? Or alternatively, you can go to oncashflow.com/M1, and that that will redirect you, because it is an affiliate link of mine, over to M1 Finance's platform. And I know you will not be disappointed. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.